Hey everyone, welcome back to Corporate Decoder, the place where we dig into the documents that companies hope you won't read too closely. Today we are reading the 10K of FitLife brands. It has brands like Muscle Farm, Isatori, and Dr. Tobias. From the title, I would guess they are selling something fitness related. Let's see if they are fit and rich at the same time. This is their annual report where they tell everyone how they did the past year. It is for the fiscal year that ended in December 2024. In it, you will see the good, the bad, and what risks they think they might encounter. So put on your seatbelts and let's get to it. FitLife brand says they sell nutrition and wellness products to health-conscious folks. Their products include sports nutrition, weight loss, and general health supplements. They sell under brand names like NDS Nutrition, PMD Sports, Isatori, and Dr. Tobias, as well as Muscle Farm, which they acquired. These guys are spread out on sales channels. They sell in GNC franchise stores, retail locations such as Vitamin Shoppe, and online through e-commerce platforms like Amazon. It is interesting to see how those sales channels are doing and if some are pulling more weight than others. Let's talk about something that happened recently. In February 2025, they did a 2-for-1 stock split. This means they doubled the number of shares available, but the value of each share was halved. For example, if you had one share worth $20, after the stock split, you have two shares worth $10 each. Companies do this to make their stock more attractive to smaller investors, but it doesn't really change the overall value of the company. All the share numbers in the report have been changed to reflect this split so we can compare apples to apples. Here's something important. FitLife brands depends a lot on Amazon. About 66% of their sales in 2024 came through Amazon's US marketplace. That means more than half of their sales are coming from a single source. They are at the mercy of Amazon's rules and fees. If Amazon changes something or even kicks them off the platform, it could really hurt FitLife's business. I am sure they will mention this in the risk section. They also rely on GNC, another big customer. About 23% of their sales in 2024 came from GNC stores. While it's good to have big customers, relying too much on just a few can be risky because those can decide to change their mind about you very fast. If GNC stops buying their products, FitLife's revenue will take a hit. To increase sales, they need to sell more products through their partners as well as directly to the end consumer. This means dealing with regulatory and legal barriers, particularly when selling products internationally. They might have to change their product formulas to meet local requirements, or they might not even be allowed to sell certain products in some markets. Navigating all of this takes time and money. FitLife brands knows their brands and formulas are important. They try to protect them with trademarks and patents, but it's not always easy. If someone copies their products or infringes on their trademarks, it could hurt their sales and brand value, so they need to be careful and protect their intellectual property. Let's acknowledge the elephant that isn't in the room, but kind of is. They mentioned that COVID-19 impacted supply chains, especially for raw materials from China, which impacted their suppliers and partners. It sounds like they were able to mitigate that, but you can never know what could happen and what kind of black swan event could happen again. They were profitable in both 2024 and 2023, which is good news, but they warned that they might not always be profitable. If their sales drop or they can't manage their growth, they could end up losing money. Like many companies, FitLife Brands is worried about trade policies and tariffs. Many of their raw ingredients come from outside the US, and if the government puts tariffs on those ingredients, it could increase their costs and hurt their profits. They also have debt, which can be a double-edged sword. It can help them grow, but it also comes with restrictions and covenants. If they don't meet those covenants, they could default on their loans, which would be a major problem. This is accounting mumbo-jumbo, for the report's valuation of their business might be wrong. They hold goodwill and intangible assets on their balance sheet related to brand value. If anything happens, that might reduce the market's perception of their brand social media going wild. Some ingredients being found to be harmful, then they might be forced to write down the value of that brand, which makes them look not as valuable as they thought they were. Like pretty much every company, they recognize that lawsuits could pop up, whether it is from product liability, false advertising, or intellectual property fights. Even if they win, lawsuits can be expensive and damage their reputation. This day and age, cybersecurity is everyone's concern, and they are no exception. They say that they have processes to protect their systems and data, but they are still at risk of cyber attacks. If they were to get hacked, it could disrupt their business and damage their reputation. Now let's get to the financials. Revenue for 2024 was up to about $64.5 million compared to $52.7 million the previous year, an increase of 22%. So sales are up, which is good. They mentioned it is largely because of the two acquisitions they did, partly offset by a decline in the revenue they had before that. Their cost of goods sold, or the cost to manufacture their products, also increased 16% to about 36.4 million. However, the cost is smaller than their sales increase, so it seems that they are making more money than they are spending. Their gross margin, or the profit they make on each product, increased to 43.6% from 40.7%. This means they are becoming more efficient or selling higher margin products. They made a net income of about $9 million, which is a 70% increase from 2023. This is because of the increased sales from the acquisitions, higher profit margins, and a reduction in acquisition-related costs. Basically, they're making a lot more money and doing a lot better than the last time. It seems that a large portion of their business are intangible assets, such as brands, formulations, and other things. I mentioned this before when talking about risk, and here is why. For example, they valued brands alone as 26 million. It is easy to get it wrong and sometimes overly optimistic and will be prone to changes in value. I am not saying it's incorrect. I'm just saying it's risky because it's hard to pin down. They appear to be able to generate cash from the business they run, since cash from operation went from 4.2 million in 2023 to 9.6 million in 2024. I call this actual money, since everything else on a 10K can be more or less subjective depending on valuation models. This is at the end of the day how much they're putting in the bank. Finally, after taking a peek at their subsequent events, it appears that the people running this company think they did a good job and are set up for success in the short term. So with all that said, what do I think of FitLife Brands? They are on the right track to grow and are diversifying through acquisitions. It is a decent way to grow as it puts you directly in an already existing revenue stream, although there are risks in overpaying. They are still fairly small but have positive cash flows to keep on expanding. They will need to be more diversified than just relying on Amazon and GNC. It's risky to depend too much on a few big customers in case something goes wrong. They need to protect those brands from copycats and make sure those intangible assets remain strong, since that's a huge part of their company value. Thanks for watching. I hope you enjoyed this 10K decoder of FitLife Brands. If you found this helpful, give it a like and subscribe for more financial deep dives. What are your thoughts on this company? Let me know in the comments below.